There's a simple do-it-yourself investment strategy that consistently outperforms most professionals on Wall Street. It requires almost no time to manage, it costs almost nothing, and it gives you access to thousands of investments around the world in just 3 steps. It's called the 3-fund portfolio, and today I'm going to show you why it works, exactly how to build it, the funds you'll need, and the historical results that prove its power. Stick with me to the very end because I'll cover the most common mistakes people make when using this strategy and how to avoid them. And if you want to take control of your finances and build wealth step by step, you're in the right place. Don't forget to like and subscribe so you don't miss future videos. So let's start at the very beginning. What exactly is the 3-fund portfolio? At its core, it's a portfolio made up of just 3 simple index funds. That's it. No complicated trading strategies, no stock picking, no chasing the next hot sector, just 3 funds that give you exposure to thousands of investments around the world. The first fund is a total US stock market index fund. When you buy this, you instantly own a tiny piece of thousands of American companies. That includes everything from giants you know, Apple, Microsoft, Amazon, all the way down to mid-sized firms and even small businesses that are publicly traded. It covers the entire spectrum of US stocks. The second fund is a total international stock market index fund. This one adds global diversification while including companies outside of the United States. We're talking Europe, Japan, Canada, emerging economies like India and Brazil. And with this single fund, you gain exposure to thousands of international companies that operate in every industry imaginable. The third piece is a total US bond market index fund. Bonds are essentially loans made to governments and corporations, and this fund spreads your money across short-term, medium-term, and long-term bonds. It's designed to balance the risk of stocks by adding stability to your portfolio. When you put all 3 together, you're holding more than 20,000 different investments worldwide all at once. And you're doing it in the simplest way possible. You don't have to guess which company will outperform. You don't have to follow market headlines every day. You just own the entire market. And that's why this strategy is so powerful. It's broad, it's simple, and it's extremely hard to mess up. The first big reason the 3-fund portfolio works is diversification. Now I know that word gets thrown around a lot, but let's talk about what it actually means in plain English. Diversification is just a fancy way of saying don't put all your eggs in one basket. If you invest all your money in a single company and that company struggles, your portfolio takes the hit directly. But if you spread your investment across thousands of companies in multiple industries and even multiple countries, then the impact of one company's failure is almost nothing. When you buy a total US stock market index fund, you instantly diversify across about 4,000 American companies. Add a total international index fund and you tack on another 7,000 companies around the world. Then the bond fund gives you exposure to over 10,000 different bonds. All told, with just 3 funds, you own more than 20,000 different securities. The second reason this portfolio is so effective is because of cost. The reality is, many financial advisors charge about 1% of your portfolio every single year. Now, 1% doesn't sound like much, but when you add it up over decades, it can cost you tens of thousands of dollars. And it's not just the explicit fees. Many advisors also earn commissions or kickbacks from the funds that they recommend. That means they're not always incentivized to put you in the lowest cost option. Instead, they might put you in that fund that benefits them financially and not necessarily you. That's a conflict of interest, and it's more common than people realize. Next, we'll be talking about another important point, active management versus passive management. But before we jump into that, here's where I personally buy Bitcoin and other cryptocurrency, and I've been using them for a while now. All opinions are my own, and we're not influenced by Gemini. I've found Gemini to be one of the safest and easiest exchanges to buy and sell Bitcoin and crypto. I personally set up a recurring purchase order for Bitcoin once a month, and it's made crypto investing so much easier by automating and streamlining the process of dollar cost averaging into Bitcoin, and it's definitely paid off tremendously well for me in the past few years. I honestly don't know if I would have been as disciplined or consistent with Bitcoin and crypto investing if I didn't have an easy, automated way to set up recurring buy orders. Especially when the market is down and all of the ticker symbols are flashing red and I'm too afraid to buy more, even though history shows time and time again that dollar cost averaging is such a powerful way to consistently build wealth in an asset that goes up over a long period of time, like Bitcoin or the United States stock market. Gemini operates in all 50 US states. They're trusted by some of the most well-established well-established financial authorities like Forbes and NerdWallet and many more. And you can set up recurring buy orders as low as $5 in any crypto you want, in any time frame you want, whether it's once a week, once a month, or a custom buy schedule that you choose. So if you're interested, click the link in the description. Thank you guys for listening, and now let's get right back into it. This brings us to another important point. Active management versus passive management. Active funds is run by teams of people whose job it is to pick which stocks or bonds to buy and sell. They're trying to beat the market. Passive funds, like index funds, simply hold every stock in a market index. There's no guessing, no predicting, they just mirror the market itself. The data is overwhelming on this. Over 10, 20, 30 years, very few active managers beat the market after fees. In fact, the majority of them underperform. That means if you're paying higher fees for active management, you're often paying more money for worse results. Think about how hard it is to consistently pick the right stocks at the right time. Even professionals with unlimited resources struggle to do it. The 3-fund portfolio takes that challenge off of the table. Instead of trying to outsmart the market, you simply own the market. That's the entire philosophy behind index investing. Don't try to find the needle in the haystack, just buy the whole haystack. And that's exactly what this portfolio allows you to do. Let's drill down on costs for just a moment, because they matter more than almost anything else in investing. Studies have shown that the single best predictor of a fund's future performance is its expense ratio, which is the percentage of your money that goes to fees each year. And here's where index funds shine. Many total market index funds have expense ratios as low as 0.03% to 0.05%. To put that in perspective, if you invest $10,000, you're paying $3 to $5 per year in fees. Compare that to many actively managed funds where you could be paying $100 or more on that same $10,000. Over decades, that difference compounds. Every dollar you don't pay in fees is a dollar that stays invested and earns returns for you. That's why keeping costs low is a non-negotiable. And that's why the 3-fund portfolio is so efficient. It uses some of the lowest cost funds available. So how do you actually put this into practice? The first step is choosing your 3 funds. If you're with a major brokerage like Vanguard, Fidelity, or Schwab, you'll find all 3 options available. The second step is deciding on your asset allocation. That simply means how much of your money goes in each of the 3 funds. And this is one of the most important decisions you'll make because it determines both your risk level and your potential returns. The trade-off is simple. More stocks means higher expected returns, but also more volatility. More bonds means lower returns, but more stability. A common allocation is 80% stocks and 20% bonds. That gives you plenty of growth while still adding some stability. If you want less risk, you might go 60-40. If you're young and you can handle more swings, you might go 90-10. The third step is consistency. Once you set your allocation, stick with it. Invest regularly, whether it's monthly, quarterly, or whatever schedule really works for you. And rebalance about once a year to bring your allocation back in line. And that's it. Here's the part that often gets overlooked. The hardest thing about investing isn't picking funds, it's staying invested when the market drops. Think back to 2008 during the financial crisis. If you had $1 million portfolio that was fully invested in stocks, you could have watched it fall to nearly $500,000 all the way from $1 million. That's definitely a gut punch, and most people panic in that situation and sell out of fear. But here's the truth. The only people who actually lose in a downturn are the ones who sell at the bottom. Those who held on eventually recovered and then some. That's why discipline matters so much. The simplicity of the 3-fund portfolio makes it easier to stay disciplined. You don't have to constantly second guess your strategy, and you don't have to decide which stocks to sell. You just keep buying your 3 funds year after year and let time do all of the heavy lifting for you. So let's bring this all home. The 3-fund portfolio gives you instant diversification across thousands of investments. It keeps costs as low as possible, it eliminates the need for expensive advisors or complicated strategies, and most importantly, it gives you a straightforward plan you can actually stick with. Here's how you apply it. Open an account with a reputable brokerage, pick your 3 funds, decide your allocation, contribute consistently, and rebalance once a year. And that's pretty much it. Now I need to leave you with one final reminder. There will be times when markets look ugly. There will be recessions, bear markets, global crises. Your portfolio will fall in value, and that's normal. The key is not to panic. Stay invested and stay consistent. Over time, that discipline is really what's going to grow your wealth. If this breakdown helped you at all, tap that like button so more investors can find it, and make sure you're subscribed subscribed for weekly videos on wealth building and investing in the technologies shaping our future. Don't forget to check out Gemini and the link in the description for the safest and easiest way to dollar cost average into Bitcoin and other cryptocurrencies. Gemini is one of the best platforms out there to automate investing so you don't have to worry about making emotional investing decisions when the markets go up and down. The most successful investors take emotion out of the equation and use automation and proven and simple principles like dollar cost averaging to help them win in the long run. Setting up recurring automated buy orders of Bitcoin was one of the smartest moves I made a few years ago, and it's really paid off for me. It's a strategy that I'll definitely continue to use well into the future. As always, thank you guys for making it to the end of the video. Thank you so much for watching, and I'll see you guys in the next one.